All right, let's just jump right in. We're all told that building wealth is some kind of game of genius. Like you have to be a Wall Street wizard or find the next big thing before anyone else does. But what if I told you the single most important factor for financial success has nothing to do with what you know and everything to do with how you behave? In this explainer, we're going to break down why your temperament is a way bigger asset than your timing.
I mean, think about it. A roller coaster can be fun, right? It's a short burst of excitement. But what if that ride just never stopped? What if you were strapped in for years with no end in sight? For so many of us, that's exactly what investing feels like. Just a relentless series of stomach-churning drops and anxiety-inducing climbs. If you've ever felt that kind of exhaustion, you are definitely not alone. It actually has a name: market fatigue. It's that feeling deep in your gut when you just want to scream, "Let me off the ride." It's not your account balance that gets worn down. It's your emotions. And that feeling, that is the single biggest enemy of long-term success.
So why does it feel so draining? Well, it's pretty simple, really. It's because most of us have been handed the wrong map. We're trying to navigate this complex psychological journey with a guide that's basically built on myths, designed for a world that doesn't really exist. So let's get you a better map.
The myth says you need a crazy high IQ and this magical ability to time the market perfectly. But the reality? It's all about emotional intelligence, your EQ. It's not about finding that one brilliant stock. It's about building quiet, consistent habits. Financial success is a soft skill, where how you behave is infinitely more important than what you know.
And part of the reason our map is so wrong is because it's incomplete. We're only ever shown the destinations of the people who made it. We study the winners, right? The billionaires, the hotshot funds that outperformed for a decade. Their stories are all over the headlines, and they completely shape our idea of what success is supposed to look like.
Nassim Taleb illustrates this perfectly with a kind of wild game of Russian roulette. Imagine a tycoon offers you $10 million to play. You see 5 people before you play and walk away rich. You'd probably think, hey, the odds are pretty good. But what you don't see is the one person who didn't make it. This is survivorship bias. In investing, it makes reckless behavior look like genius because the failures are totally silent and invisible.
So, if chasing genius is a trap, what's the alternative? Well, it's something that sounds a little boring. But trust me, this is where the real magic happens. Let's look at the simple, undeniable math that proves why a boring strategy is actually the most brilliant one of all.
Just take a look at this gap. Over a 20-year period, the S&P 500 returned over 6% a year. But the average person investing in it, they only got 4.25%. That difference, that performance gap, isn't about bad luck. It's the price we pay for our emotions, for getting scared and selling at the absolute worst moment.
And let me be crystal clear about this. This gap has nothing to do with intelligence. It has everything to do with behavior. It's what happens when you panic sell during a downturn or chase some hot trend after all the gains have already been made. It is the direct financial cost of market fatigue.
Nobel laureate William Sharpe put it best with some, well, embarrassingly simple math. Think about it. As a group, all investors owned the entire market. So before you account for any fees, the average active investor who's trying to beat the market has to get the same return as the market. But the second you factor in fees for trading and management, the average active investor is guaranteed to do worse. It's just a mathematical certainty.
And this really highlights the real secret of the greats, like Warren Buffett. His fortune isn't just because he's a good investor, it's because he's been a good investor since he was a little kid. If he had started at age 30 and retired at 60, his net worth would be about 99.9% less than it is today. His secret isn't genius returns, it's pretty good returns, held for the longest period of time possible. That right there is the power of compounding.
Okay, so this brings us to a really crucial turning point. It's a shift in mindset that, once you really get it, it changes everything about how you see the market. It's all about understanding the real price of building wealth.
We tend to see market crashes and volatility as a fine, like a penalty for being in the market at the wrong time. But that's the wrong way to look at it. Volatility is not a fine. It's the price of admission. It's the fee you have to pay for the opportunity to earn those great long-term returns that stocks provide. Once you see it as a fee instead of a punishment, you stop trying to avoid it. And paying that price leads to the single most important skill in investing: survival. Sure, getting wealthy might involve taking some risks, but staying wealthy, that's about one thing: not getting wiped out. It's about consistently avoiding catastrophic mistakes so you can stay in the game long enough for compounding to do its incredible work.
So here's the big question. Why do we even pay this price?
Why put up with all the volatility? It's not just to see a number go up on a screen. It's to earn the highest dividend money could possibly pay, control over your own time, the freedom to live your life on your own terms. That is the real return on investment.
Okay, so we've shifted our mindset. Now let's turn this into action. You don't need any extreme measures. All you need are a few simple, quiet systems that work in the background, building wealth for you while you're busy living your life.
So here's the toolkit. First, put your savings on autopilot. This is huge because it takes willpower completely out of the equation. Second, live below your means. This creates a buffer, not just financially, but between your ego and your income. Third, and I know this is a hard one, check your portfolio less. The daily noise is where emotional mistakes are born. And finally, just be consistent. Invest a set amount every single month, no matter what the crazy headlines are saying. Because time in the market will always beat trying to time the market.
Look, none of these habits are glamorous. They won't make for exciting dinner conversation. But that's the whole point. Lasting wealth isn't built with loud, flashy wins. It's built quietly through disciplined habits that you just repeat over and over again, regardless of what the market is doing. And that brings us to the final and maybe the most important idea. The end goal of this whole journey isn't a number, it's a feeling. It's a state of being.
Charlie Munger said it perfectly. He said, "I did not intend to get rich. I just wanted to get independent." The goal isn't just to get rich. The real goal is to get independent. To wake up every morning and know that you own your time, that your choices are truly your own. That's the prize.
So, what's the final takeaway here? It's that the goal of investing isn't to maximize returns, it's to maximize your peace of mind. It's to build a financial life that lets you sleep well at night, knowing that your quiet, consistent habits are securing your freedom one boring day at a time. And that is a journey worth